Talks U.S. Trade Representative Jamieson Greer told a Senate committee Tuesday the administration is not planning on offering exemptions and doesn't want what he called a Swiss cheese solution. More on that later. China, the world's second largest economy, also said Tuesday it's willing to, quote, fight to the end amid a tariff back and forth with the U.S. President Trump is set to raise the tariff rate against China to 104% Wednesday after Beijing put an additional 34% tariff on U.S. products. This is on top of 10 to 15% tariffs imposed on some U.S. agricultural goods and energy and farming equipment. CBS News Money Watch correspondent Kelly O'Grady is here with me on set to break down the markets. White House reporter Aaron Navarro is in Washington, and congressional correspondent Nicole Killian is on Capitol Hill. Stocks started the day up, then they were down. I mean, is this really like hour by hour reacting to news reports, or what's happening?
Minute by minute, it feels like.
Minute by minute.
So look, what happened is that there were talks of potential negotiations that we just heard the president say, and investors were really excited about that. It was also, frankly, it was a good buying opportunity because some companies have lost so much in value that they were at a better price than they have been in the past month or two. So as the day went on, and you can really see it in the chart there, and we get closer and closer to this midnight deadline and the closing bell, investors didn't see those deals materialize. And they got a little bit more anxiety that these tariffs are, in fact, going to go into effect. They're going to be as severe as what we heard last week. And that raises the question of inflation and slowing consumer spending.
Let's go through some of these other developments. Canada says 25% tariffs on American auto parts will go into effect Wednesday. This is after the U.S. put 25% tariffs on foreign-made cars, imported cars. Last year, Canada imported more than $20 billion worth of American cars. So how big of a hit will this be to U.S. car manufacturers?
So U.S. car manufacturers really rely on Canada for sales. I mean, Ford, GM, these big automakers, they do really well in Canada. In fact, Ford, I was just looking it up before I got on with you, saw a 16% increase in their sales in Canada last year. So it's a growing market for them. The thing yeah, fair. I guess time will tell. Specifically about this tariff that's going into place. So it's the exact same as the U.S. So it's a 25% tariff on all the cars that are not covered under that trade agreement, the USMCA, and then the portion of the car that is made in the U.S. for vehicles that are covered under the USMCA. Yes, by your face, I know, because the thing is that the U.S. has that on these other countries, and they can't figure out how to actually calculate that. Okay. So it's sort of on hold. So you're not the only one that is confused right now. So because it's more specific, it's hard to tell exactly how much this is going to impact these automakers, because these three giant automakers, most of their cars would fall under that USMCA agreement. But yes, they do rely on this market.
We just heard the president say Japan wants to make a deal, South Korea wants to make a deal. Does any of that matter if China doesn't make a deal?
This is really interesting because if everyone else made a deal with the U.S., including the EU and Canada and Mexico, had all sort of figured out the things that are going on, then yes, that's going to leave China in a tough spot, because right now China has struggled to come out of the pandemic as strongly as they had hoped, and they are relying on exports and selling their goods to other countries in order to make that economic recovery. So if everyone else sort of teams up and makes a deal, then that is going to be tough for China. But if you do see some of these different countries decide to ally and keep the U.S. out, then yeah, China's on decent ground.
The Wall Street Journal reports that Apple is going to import more iPhones to the U.S. from India to avoid the 104% tariff from China. Look, the White House wants companies to manufacture in the U.S. That's one of the goals of this tariff policy, they continue to say. Apple's investing $500 billion in the U.S., but this suggests that exactly what you've been talking about for weeks is that mass production in the U.S., shifting operations doesn't happen overnight. What are your takeaways from that?
Well, it's exactly that. So, this was reported by the Wall Street Journal. If this is true, it's exactly what I'm hearing from a number of other businesses as well, that they are looking for other options besides China, like a Vietnam or an India. And it doesn't
Still
even
not
matter
the US.
right, but what they're thinking is, well, a 32% tariff is better than 104%. Right. And so we're going to take that because, to your point, the infrastructure, the electricity, the energy, a lot of things that's going to be required, the manpower to make all of this happen is not going to happen overnight in the U.S.
All right, Kelly O'Grady, thank you. CBS News White House reporter Aaron Navarro joins us now. Aaron, how is the White House approaching these negotiations with individual countries?
Well, they certainly are entertaining it more than maybe we first started to see last week when Trump announced these tariffs. President Trump and White House officials have claimed that up to 70 countries have reached out. We still haven't seen a full list of those specific countries, but White House officials today, including President Trump, have reiterated at least two conditions that countries should look at when they come to the negotiating table. One, find a way to reduce their trade deficit with the United States, and two, remove any trade barriers such as safety regulations on automobiles, on U.S. goods that they're taking in. And Israel specifically was cited by White House Press Secretary Caroline Leavitt as a, quote, model on both of these points. Important to note, though, with these tariffs expected to take place and go into effect tomorrow, even President Trump acknowledged there's not necessarily time for these countries to avoid tariffs and make a deal before they actually get hit with them.
How far is the White House willing to go when it comes to China before backing down?
White House officials really signaled that they are not backing down on this. Caroline Leavitt, during her briefing, said that those tariffs will go into effect at midnight. It seems clear that they're not only calling China's bluff on retaliatory tariffs, but are also inviting them to make the first move and kickstart negotiations when it comes to trade. We also heard from Treasury Secretary Scott Bessent this morning, who openly questioned what the United States has to lose if China raises tariffs on U.S. goods, noting that U.S. exports to China make up 1/5 of what they export to us. And we also heard from White House officials such as Stephen Miller, who talked about potential trade deals with other neighboring countries, with other big trading partners such as Canada, Mexico, and Europe that could potentially isolate China and put pressure on them to make a deal.
Elon Musk and President Trump's trade advisor Peter Navarro are publicly feuding over these policies. Can you explain what's going on?
Yeah, Peter Navarro and Elon Musk have been feuding in recent days because Navarro has criticized Tesla and Musk, his criticism of the tariffs. Yesterday, Navarro called Musk and Tesla, quote, a car assembler using foreign-made parts rather than a car manufacturer, in an attempt to note why Elon Musk is against these global tariffs. Today, Musk responded and called Navarro, quote, a moron, quote, dumber than a sack of bricks, and claimed Tesla has the most American-made cars. In response, we heard from Caroline Leavitt, who spun this as a moment of transparency from the White House and said, quote, boys will be boys, and we will let their public sparring continue.
Aaron Navarro, thank you. International markets are watching closely as President Trump's reciprocal tariffs are set to take effect Wednesday. CBS News foreign correspondent Ramy Inocencio has more from London.
The global market bloodbath took a breather today. Investors felt hope and saw opportunity to buy across Europe and Asia, ending 3 trading sessions of plunges. The FTSE 100 here in London, Germany's DAX and France's CAC 40 closed near highs of the day, up about 2.5%. And that followed Asia markets also closing higher. Japan's Nikkei closed up by a little more than 6%. And one of the main drivers for all of the green on the boards was that President Trump said that Tokyo is sending a negotiating team to the United States. So there is hope that if Japan can strike a deal, other countries might be able to as well. China markets closed higher, but less so because Beijing has chosen retaliation over negotiation. But in more hope, Trump said that South Korea is now also sending a delegation to talk. I spoke to chief market analyst Chris Beecham here at IG Group, and he says that jumps today are still probably what we call a dead cat bounce.
It's rare that you see markets bottom so quickly.
It has only been 3-4 trading days.
It's exactly only been 4 trading days. Usually these crises are more drawn out. We do have obviously one specific cause, and if tariffs were taken away tomorrow, you'd expect that to be the bounce. But the worry is that we haven't seen the low just yet, or the final low.
So hold on for possibly more falls. Trump's reciprocal tariffs are scheduled to take effect after midnight tonight in Washington, and IG Group sees the U.S. now at about a 40% risk of recession this year, similar to other major financials. Back to you.
Ramy Inocencio, thank you. President Trump's U.S. trade representative is defending the administration's sweeping new tariffs while facing tough questions from some senators. Jamieson Greer spoke in front of lawmakers on the Senate Finance Committee Tuesday, and they pressed him on the tariff's potential impacts. Greer said there's been good news already, with representatives from nearly 50 countries approaching him personally to discuss the new policy and ways to reach reciprocity. CBS News congressional correspondent Nicole Killian asked Greer about his comments following the hearing.
Why aren't there any exemptions with some of these tariffs, sir? president decided that we're not going to have exemptions. We can't have a Swiss cheese solution to this universal problem that we're facing.
Nicole Killian joins us now. So, Nicole, what else do we learn from Greer's testimony?
That was really the crux of his argument to lawmakers, that the trade deficit has really ballooned over the last several decades. It's well over $1 trillion. And so in order to get it down, that this type of action on the part of the president is needed. It's something that can't be fixed overnight. So that is the case that he tried to convey, and the argument that he tried to make to lawmakers in terms of why the president is taking this action now. And as you heard him say there, which he also reiterated to lawmakers, is that at least at this particular time, that the president doesn't have any plans to enact any exemptions. And that is something that Greer was pressed on pretty extensively by both Democratic senators and Republican senators, who really, had a lot of questions and skepticism about whether this tariff policy will ultimately work. They talked about the calls they are getting from small business owners, from people on Main Street, and from their respective communities, from farmers. And so they really wanted to kind of know what the end game is here, whether or not the president could be more targeted in his approach versus taking this blanket approach with tariffs. But again, as you heard the trade representatives say there, that's not going to be the case at this time.
So how are lawmakers you spoke to reacting to the hearing?
Well, by and large, the reaction was mixed. I did ask a number of lawmakers whether they felt satisfied after the trade representative's testimony today. Take a listen to what two senators, one Republican and one Democrat, told me.
The purpose of the tariffs are to bring people to the negotiating table. And if the president does that, that's a satisfactory answer.
You look at the whole world's reaction, and we can call that a good day in hospice or a dead cat bounce in terms of the markets today. Tonight at midnight, because you'll start seeing prices rise, I think, later this week. That will, I think, shock some more of my Republicans into speaking in person what they say to me privately.
So obviously, that was Democratic Senator from Virginia, Mark Warner. Chuck Grassley, the Republican from Iowa, who I would note, by the way, is a sponsor of a bipartisan bill that would claw back congressional authority over trade policy. And that's why I asked him if he was satisfied with the trade representative's answers, because he did talk about, what he is hearing from farmers in Iowa. And again, really tried to press Greer on what that end game might be. Similarly, Senator Warner also talked about these small businesses in Northern Virginia that rely on getting a lot of their materials from different parts of the world, and that this is really crushing a lot of small business potentially. So there was a lot of concern expressed at this hearing. But again, lawmakers are, at least Republicans, are trying to keep an open mind. That's what Senator Grassley is trying to do. But at the same time, many remain concerned, again, about what that end game might be.
I got to be quick with you, but what is the latest on the budget resolution?
Well, obviously, that is a key part of the president's agenda right now. House Republicans are hoping to clear the latest version of this budget resolution this week. But so far, there's still a lot of arm twisting going on, even after a meeting earlier today at the White House between the president and some House Republicans. But Speaker Johnson is still confident he can get it done this week.
I don't know how you have time to track down all these topics, all these lawmakers to get interviews on top of all the hits you do for us. Nicole Killian, thank you as always.
Good evening from New York. I'm Chris Hayes. Well, here we are now on day 78 of the second Donald Trump presidency, and we are on the precipice of a trade war that has no precedent in modern history. Trump's saying that starting tonight at midnight, the U.S. will tax imports from China at a rate of 104%, an announcement that sent stock markets back into free fall as everyone contemplates the world's two biggest trading partners bringing global commerce to a halt. Now, basically, every economist across the spectrum, with maybe a few exceptions, thinks this is a disaster. The conservative opinion writers of the Wall Street Journal, who helped elect Donald Trump twice, are absolutely freaking the F out that Donald Trump is killing free trade in the American economy. Even Trump's unelected co-president, Elon Musk, is reportedly pleading with Trump in private to reverse course on the tariffs. Publicly, he's fighting online with Peter Navarro, Trump's top trade advisor and the architect of Trump's tariff plans. Musk called him a moron. He called him dumber than a sack of bricks and worse. Amid all this, there has been this desperate, almost kind of pathological search for some sort of reason at the core of Trump's policy here. And so you're seeing the MAGA faithful spin this in the media. They've created, and not just them, I think some in the mainstream media as well, they've created this kind of alternate steelman version of what Trump is doing, where what he's trying to do is recreate the middle-class economy of the post-World War II boom years that many people have genuine nostalgia for, because it was the best time for certain folks. I mean, particularly white folks with college degrees, to enter the middle class. You had a strong, growing industrial manufacturing base, meant those folks could get union jobs, paid a good wage, have benefits in healthcare, send their kids to college. You had huge home production, right? And the 30-year mortgage, you could buy a home cheaply. And again, there's a reason that people across the political spectrum, I mean, liberals, conservatives, everyone in between, tend to hearken back to the days of high union density, low inequality, a growing middle class. It really was good for a lot of people. So, again, the charitable argument, and you're seeing this everywhere. Once we hear this, you'll see it, for what Trump wants here, the reason that he's started a global trade war that may very well impoverish the whole world and the U.S., that what he wants to do is go back to the heyday of the 1960s, the Wonder Years opening credits, and who doesn't want that? But here's the thing, and I cannot stress this strongly enough. That is absolutely not what he is doing. It's complete wish casting, because he keeps telling us what his actual goals are here.
The country was at the richest point in its history in the 1890s. It was all tariffs. If you looked at William McKinley as an example, he was a big tariff president. In the words of a very great but highly underrated president, William McKinley, I am a tariff man standing on a tariff platform. If you look at some of McKinley's words, he was very beautiful. From 1789 to 1913, we were a tariff-backed nation, and the United States was proportionately the wealthiest it has ever been. Then in 1913, for reasons unknown to mankind, they established the income tax so that citizens, rather than foreign countries, would start paying the money necessary to run our government.
The foreign countries don't pay the tariffs! But that aside, as you can see from that nice montage we put together, it's not about the 1950s, it's not about the 1960s, it's not boomer nostalgia, it's not the Wonder Years. It is quite explicitly about taking us back to the 1890s, to pre-1913, to William McKinley. He said it on the campaign trail over and over and over again. He said it on the day he announced the tariffs to the world. He is also very clear and consistent about why. The President of the United States, and again, he said this many times, just hopes this $6 trillion tax hike he is unilaterally slapping on you via all imports to the U.S., most of which will be paid by working middle class and poor folks, will raise revenue he can then use to hand over to the billionaires by either massively cutting income taxes or getting rid of them altogether. It is a plan economists call unrealistic, unattainable, bad math. It would be wildly regressive. But even if the math could work, think about it. Again, the period he thinks is the golden era, the heyday he's returning to, is the Gilded Age. And tariffs are the way to get there. And part of the reason it is such a just idiotic, destructive, insane idea, and no one can really actually upset that's what he wants, even though that's what he's telling us. It's like the opposite of Morning in America, right? A shining city on a hill, an America of the future. You want to know what that era was about? Rampant tuberculosis in tenement slums, non-existent public services, poor sewage, heavy industrial pollution, robber barons lording their insane wealth over everyone. No one but, like, billionaires could possibly want that. I mean, they did build a bunch of nice houses in Newport, Rhode Island, but... And what about those manufacturing jobs, right? Isn't it all worth it if it brings heavy industries back to the United States? Yeah, maybe to factory owners, possibly, for workers. Again, we're not talking about high-paying unionized assembly line jobs of the 1950s, 60s here. So don't think GM. Think Triangle Shirtwaist Factory of the early 1900s. Or, the 21st century version, I guess, as described by Commerce Secretary Howard Lutnick.
Trillions of dollars of factories are going to be built in America. That's huge GDP. The factories being built in America are huge.
That takes
GDP.
years. And you've said that robots are going to fill
us.
those jobs. So those aren't union
No, it's really automated
jobs.
It's automated factories, but the key is who's going to build the factories, who's going to operate the factories, who's going to make them work. Great American workers. The army of millions and millions of human beings screwing in little screws to make iPhones. That kind of thing is going to come to America. It's going to be automated, and great Americans, the trade craft of America, is going to fix them, is going to work on them.
Bro, what are you talking about? That's the vision? That's a vision. It's honestly too self-contradictory to call it a vision. The screwing of the little screws will be in America, millions of people doing it, but it will be automated, and then the great American workers will be proudly fixing the robots that do the screwing? Who's getting screwed? If you err on the side of taking it all seriously, which again, it takes some effort, or believing that Trump wants to see this through and cause a global trade war and send us back to the 1890s, which I think is where we're at. The only thing that can stop it right now is probably Congress. And what's surprising is it looks like it might be starting to move a little bit in that direction. Today, senators from both parties got to grill Trump's trade representative, and Republicans did not hold back.
Who pays these high tariffs? In the short, medium term, it will be the consumer. It'll be the consumer. And so I'm worried about the inflationary effect. I'm worried if there is a trade war, that we're going to have markets shutting down for American farmers.
I don't often agree with the members on the other side of the aisle, but in many cases here today, particularly when they're expressing concern about small businesses in their states, I'm hoping you're very, and I hope you and the president are very sensitive about companies potentially going bankrupt by these actions.
Whose throat do I get to choke if this proves to be wrong?
That last senator there, that's Tom Tillis in North Carolina. He's up for re-election in a swing state. He's also one of 7 Republican senators who are now backing a bipartisan bill that would require Congress to approve President Trump's tariffs on trading partners. Under that bill, sponsored by Republican Senator Chuck Grassley of Iowa and Democratic Senator Maria Cantwell of Washington, any tariffs imposed by the president would expire after 60 days unless Congress voted to approve them.
Order filled. Order filled. Order filled. Order filled. Order filled. Order filled.
passion of mine now to actually help beginner traders at the beginning part of their journey. Because the two skills are knowing when not to trade, which hardly anyone tells you about. No, because it's all about. But then the other side is getting everything set up, not doing it, and watching it win. Yeah. And then you go, yeah. Well, what's going on? Yeah. Well, that's a big thing to get. Yeah, that's actually learning and creating a system. Yeah, exactly. You go back to the confluence, but even the best traders, they'll too late, so they don't have the same issue. Yeah, and this is the thing, like, I've known quite a lot of traders, and I know a lot of their stories, and more recently I've kind of been a lot more active on my socials, and people have been saying things like, why would I learn from you if you've just lost money? And for me, like, why would you from most things so that you it's a learning curve, you know, like I've learned from them, other people can learn from them. So actually I kind of fell into teaching because I was helping my friend and she really struggled with, you know, all the terminology of it. And I think this is why I became so passionate now about building my female community, because a lot of my girls are like, I would love to do it, but I would never approach these guys. It's really complicated. They're very aggressive. Like when they started, I would ask for help, but they were like, no. Yeah, it's just kind of sink or swim. Whereas I think with women, there is a bit more of a softer approach when it comes to business and teaching. You know, that you can have a feminine touch to it. So recently, I've had a lot of women come forward saying, I really want to learn how to do this, but you know, it just looks so complicated. Like I said, everyone makes it seem very, very complicated, and that's just. There's a way of getting through it. Yeah, and I think that's. Do you look at fundamentals and data, or you just? So that fundamentals, I do look at it, but it's never something that I've done even kind of outside of trading. So.
Order filled. Order filled. Order filled.
Challenge, I would say, with trading has been the psychological side and getting stuck in your own head, not having anyone to talk to, because it is a very male-dominated industry. That's one of my. It's probably one of my favourite books because it had a lot of light bulb moments in it. You know, he kind of says the stats of 95% of traders lose. So why do we trade?
Order filled.
Why are we going down this route of complication and all these things that technically is put out there by so that you can lose money? It's been a fun journey, and I feel like I'm very much technically at the beginning of it because I've kind of come out the trenches. No, that's what I mean. Like it's never ending with the challenges, the personal growth, and I think for me, before having my own business, I mean, I could never really stay in one job for a year because I'm just that type of person that needs a lot of challenge, but not necessarily challenge in the work that I'm doing, but challenge within myself. And again, exactly. So that's why I think with trading, this is just the beginning, and I'm really, really excited. Like I said, I feel like I've kind of just come out of the trenches. I'm just a little bit near where I want to be, but we're on the right track. The next stage where it's a big light bulb moment to come is when you then get a fundamental overlay. Once you get time, you can't force it. It's just like the technicals. It takes time to learn, doesn't it? It takes time to learn the fundamentals, when eventually they sit together, they'll open up even more. That's what I'm sure concerned about that. Go down that road. Definitely.
So what have you been doing win-wise then? So have you been having successes?
I would say the last kind of 6 months has been for me just really refining that strategy, because until this year, this is the first time that I was really using prop firms. I've always traded my live money.
Because that is an even
Exactly.
money, not just it's money gone.
Real money, but I would say now I have found a strategy that works really, really well for me. And I've cut back the amount that I trade, but my win ratio has gone up quite significantly.
Oh, fucker!
Because they used to
Order filled.
use multiple different strategies. Simple price action. I've really got to know, again, like I said, what my personality is like. I'm definitely breakouts, so I'm purely candlesticks pretty much. I'm a scalper.
When you're struggling, just go and spend the whole day watching actual action.
And like I
Not to see where it's on. People talk about over the blocks. And it gaps. See it. See when someone's moved their limit.
It's very, very interesting. And like I said, I'm a very reflective person, so I like reacting to the market rather than predicting, because I used to try and predict it. It doesn't seem to sit with you. Exactly. Whereas with price action, I feel like I'm just reacting to it in real time.
Because it's a decision made off of everything you've seen.
Exactly. And you can kind of follow those simple
Order filled.
that you kind of put in place. But like I said, for me, I want to be in and out of my job
Order filled.
at this stage in my life. It's not that way forever, but just circumstances right now. I don't want to feel anxious because I'm in a trade all day. I want to be in and out of the market. And like I said, I being reflective, so I like observing the market, seeing how it moves when it gets to certain areas, picking up those candlestick patterns, and I feel like something can be just switched with it instead of
Order filled.
It's still a work in progress, but that's why I think, this is the beginning of the journey.
What the hell's it been like trading since Trump got in? What do you think about him and Musk?
Yeah, it's brought quite a lot of volume, and I've actually quite enjoyed it. Because like I said, ever since I have purely focused on price action, I don't try to predict what's going to happen. I'm just, yeah. The strategy that I use, which is the breakout, at the moment is brilliant for me. Whereas I know a lot of people are struggling with it because, it gets to an area and they're like, it has to go down, it has to go up, and it doesn't yeah.
I think AI or something is all over gold.
Yeah.
So many classic TA setups. You're a momentum trader, Catherine.
Yeah, exactly. So I've actually been loving it, and I think for me that again was another light bulb moment of, I need to stop trying to fight against the market and just go with it. I don't want to.
It's hard to come to her.
100%.
As well.
Yeah. That's what I mean, because I was struggling with it, but then yeah,
Order filled.
cancel out the noise. I had to just get rid of all these indicators that were confusing me, and this saying this thing and that saying that thing, and just go with what I can see. And I think in a market like this, it works really, really well. Yeah, fingers crossed.
So, Catherine, I hope you enjoyed those. We've gone on for a long time, as you mentioned, so but that shows you doing some fantastic insights into the trading world. If it's a hard start, keep at it. Learn as much as you can, stick in the game, and hopefully you'll find your place. And it is really all about finding your own way in the world, isn't it?
Yeah, 100%.
Fantastic. You stick with it. Fantastic story. Thank you for talking to us today.
Amazing. Mark's joined us on a day of turmoil after putting out a memo about a month ago where he wrote, "The bottom line is that credit presently offers a better deal than equities. Even at today's spreads, credit isn't a giveaway today, but it offers healthy absolute returns and it's fairly priced." Howard joins us right now. Howard, you wrote that a month ago. The world has changed. We have seen the market sell off. We have seen tariffs implemented that are the highest levels that we've seen going back 100 years. Does your thesis still hold?
The yields on credit are still very healthy, and in fact, credit yields a little more now than it did 6 weeks ago when I wrote that memo. Then high yield bonds, for example,
Order filled.
7.2 today they're close to 8, which means they went down in price, producing a higher prospective return. Of course, the stock market is well down since then. I don't know, 15, 16, 17%. I haven't done the math yet, and it keeps moving. But obviously the state of the world, which equity prices depend on, is completely in flux and has been radically changed. Most investors think for the worse. That's why prices are down. The question, of course, is whether they're down too much, just right, or not enough, and almost nobody can say.
How do you start to even measure something like a potential paradigm shift, like the tariffs that were announced earlier this week?
Well, first of all, of course, measure is the wrong word because that suggests some quantification, which is impossible. There's nothing to measure. But how do you gauge? How do you think about the changes? And this is the biggest change in the environment that I've seen probably in my career. We've gone from free trade or world trade and globalization to this system which implies significant restrictions on trade in every direction and a step toward isolation for the United States. I believe that the last 80 years since World War II have been the best economic period in the history of mankind, and one of the major reasons
Order filled.
the
and sell them to other people. That's how trade works. And, well, I don't know if it's politically correct, but the good news is that the Italians make the pasta and the Swiss make the watches. But if we can stop world trade and the Swiss have to make their own pasta and the Italians have to make their own watches, the world will probably,
Order filled.
people in both countries will be a little worse off. That's what we're talking about here. And we should not underestimate the benefits that we've gotten from globalization. And among other things, there was a 25-year period, which I cited in one of my memos 10 years ago, in which the cost of thermals in the U.S. went down by 40% in inflation-adjusted terms. That kept a lid on inflation here. It made goods available cheaply to all Americans. If we don't have world trade, we don't have that benefit. And, you know, the tariffs are designed to encourage production at home. But who could imagine that most things produced in the United States will be as cheap as they are from abroad? In other words, things will cost more.
If that's the case, does that mean that you see the inflationary regime as being something that is more persistent or reversal of what we saw the disinflation of the globalization?
Well, I think so. There were financial benefits from globalization, including keeping a lid on inflation. And we had bought our TV sets and appliances from abroad in that 25-year period at declining prices. What would inflation have been? The answer is considerably more, maybe 2, maybe 3, 4, 5. And so, you know, tariffs are an increased cost. Somebody has to pay them. And, you know, most people think the consumer will pay them. There's a possibility that the importer or the exporter will pay them, or the government of the exporting country. But it's an increased cost. Proceeds from which will go to the government. And will society be better off as a result?
When you're measuring how to decide the risk and reward given asset classes in this type of environment, that could go in a multitude of different ways. How do you understand where there's value, what a return is that would justify a risk at a time when, you know, potentially you could get 7, 8%, 9% with credit, with stocks that have delivered more than 10% for the past number of decades? Going forward.
I want to respond first to your last sentence. Stocks have delivered an average of 10% a year for the last 100 years, but not when the PE ratio was 19. And the PE ratio today is probably 19. The average return has been 16. So we can say that when the PE ratio averages 16, the return average is 10. But when the PE ratio is 19, my guess is, if you look at history, if you bought the S&P when the PE ratio was 19, historically you probably made, let's say, 1 to 6% a year, or 2 to 7% a year, something, but certainly not 10. And so, you know, what you pay matters. The price of the S&P is elevated relative to historic levels, so you shouldn't expect historic returns.
Whereas in credit, one of your arguments is you can expect to get that return because the default risk isn't as great as some of the excess spreads and what you're getting in all-in yield.
Well, you know, with credit is a newfangled word for fixed income, which was a newfangled word for bonds. In 1978, I was moved at Citibank from the equities department to the bond department. Nobody talked about fixed income or credit. But with debt, or bonds, or fixed income, or credit, what you see is what you get. You can read on the piece of paper what the promised return is. And then the only thing you have to wonder about is, will I get it? That is to say, will the issuer default, or will they keep their promise?
scientists you can do to determine whether today's asset prices are right for the environment ahead. Now, there never is. It's always conjecture. It's always guesswork. That's, in theory, why the greatest investors
Order filled.
because they make those judgments better than most people. It's excessively hard today because today we have no idea what the future is going to be. We think we know what's going to happen in the future. We normally assume the future will look mostly like the past. We extrapolate, and usually it works because the world doesn't change that much. The world economy and the world order beyond the economy, meaning geopolitics and international relationships, has been shook up like a snow globe by the events of the last days. Nobody knows what it's going to look like.
Oh my God! Look at that.
Nobody knows. I dare say, if you tell me that what our rules will be 6 months ago,
Order filled.
6 months from now, I bet you're wrong. This is in flux, and if you think it's in flux, then by definition you don't know what the future holds.
Order filled.
Even if you know what your country's going to do, and it's going to be that way 6 months from now, we don't know what other countries are going to do, what the ramifications will be. And so, I always inveigh against forecasting. I don't believe in macro forecasting. I order indicators, and we know much less today than usual. People who like to run their lives according to forecasts, they say, well, this is going to happen in the future, so I'm going to do this, and this is going to happen in the future, so I'm going to do that. But you really know.
Order filled.
To work with forecasts, you need two things. Just a forecast. You need the forecast, but you need an estimate of the probability that your forecast is correct. Today, whatever your forecast may be, you have to say the probability that I'm right is lower than ever because the probability that we know what the future is going to look like is lower than ever. That's how I feel.
Is this a time to be fearful or greedy?
What you have to say, Bloomberg's offices, you have to think in terms of your neighbor. The department store. Bloomingdale's just put everything on sale. Prices have come down for the S&P 8% in the last 2 days, and much more in the last 6 weeks. It's on sale. That should encourage people to think about buying. Will they go down further? Nobody knows. Will the price is fair? Nobody knows. Everybody runs from the market when prices go down because they think it connotes risk. It's just stuff going on sale. And, of course, it takes, well, I was going to say a pro, but it takes a Messian pro, of which there aren't many, to know whether, as I keep saying, the discounts are inadequate or appropriate. Certainly, you have to look. It doesn't make any sense to say, just a minute, I did X, Y, Z when the price was 100. Today the price is 90, so I'm going to boycott it. It doesn't make any sense on its face. You have to take a hard look.
Do you still think that the U.S. is the best place to invest?
I think it's probably still the best place, but it's less best than it used to be. Because I think that, if you think about the things that made it this place, one of them was the rule of law. That may be almost the fact today. One of them was the predictability of outcomes. It may be less today. One of them is the worst thing about investing in the United States for many years has been our fiscal situation, our deficits and debts. And the U.S. has behaved like somebody who has a golden credit card where there's no credit limit and the bill never comes. So, of course, you can spend more than you make. And if somebody has a golden credit card, which would you do? Well, you might buy an ice car, but what the hell, you might as well buy the cars because the bill's not going to come. And that's the way we've behaved. And that's the way Washington has spent money. But can the events of the recent days change that? Can they cause there to be a credit limit? Can they cause a bill to be presented at some point in time? And if the answer to either or both of those questions is yes, it's a real risk. If people don't like the dollar, don't like investing in the United States, don't want to hold an unlimited number of treasuries, if we just make people mad and say the U.S. is still a great credit, I don't want to hold their debts because look how they're treating me, fiscal situation will be very complicated.
Howard Marks, we have to leave it there.
Order filled.
Co-chairman Howard Marks, thank you so much. Back to you. Are investors looking past escalation given Trump's rhetoric on
Order filled.
to the wars? Let's discuss this and more with veteran investor Howard Marks, co-chair of
Order filled.
Management, which has more than $200 billion in assets under management. Howard, good to have you with us. Such a chaotic world. It does seem like traders are underpricing the risk from geopolitics because even today, all eyes on Nvidia.
Well, you know, the world is chaotic. The future is never clear. Some people spend their time trying to figure out the future and pricing it. I'd say it's unclear, and we abstract from that. So, you know, we just try to look at individual companies and figure out which ones will grow, which one will repay their loans, and deal on that basis. We call that not top down.
How it is about intrinsic value. Everything else is baloney. But how do you get intrinsic value in a market that's overpriced? I mean, valuations are skyrocketing, especially on S&P.
You say it's overpriced. I would say it's high-priced. Overpriced is a judgment call. And, you know, you think what you think something is worth. You compare how it's selling relative to this. And then, in my opinion, this should determine whether or not you're aggressive or defensive. So I think we would agree that the U.S. valuations, for example, are on the high side relative to history. Would tell me to be a little less aggressive than usual, a little more defensive, not necessarily to get out. Getting out is really a big step. Most of the time, in my 55 years in this business, it's been a mistake. Either you get out and it goes up, or you get out and it goes down, and you forget to get back in and it goes up without you. So, you know, it's just a matter of calibrating, in my opinion, your behavior between aggressiveness and defensiveness. When things are a little high as they are, a little more defensive than usual, this notion of risk on, risk off, in or out, pay or sell, it's too black and white, is not fitting for the world we live in.
The thing is, right now, we're seeing herd mentality. Most pubs getting into everything that institutional investors are getting into. And usually, traditionally, historically, that's the time to get out.
Well, again, I was with you until you said you know, just remember this, and you know, as I said, we're not market timers. We're not macro forecasters, and I told you that before the break, and I insist it's true. You could have said, if you had a great foresight, you could have said in 2019, I think there's going to be a pandemic. I'm going to get out. In 2021, you could have said, I think that Russia's going to invade Ukraine. I'm going to get out. In 22, you could have said, I think Hamas will attack Israel. I'm going to get out. You would have been right about the events, but it would have cost you a lot of money. And we not only do we never know what's going to happen in the bigger world, but we also don't know how the market's going to react. And so to be dogmatic and to say it's high, I'm getting out, is a mistake. Warren Buffett, who always says it best, don't bet against the United States, for example. And, you know,
Warren Buffett was taking money off the table more than $300 billion worth.
Right.
look, and they say, well, if it sold some stocks, does that mean we should get out? What percentage of his stocks did he sell? Probably rather small. So it's not a broad statement. You know, if it's a little high, and I say be less aggressive. If you want to sell 2 or 3% of your stocks, I understand. But it's not selling all his stocks, and neither, I think, should any deals.
Howard, you talk about how you hate making calls, you know, predictions, estimates, but Goldman came out to say that it sees further 10% upside in the S&P from now through the end of 2025. Is Goldman right? 10.
Well, that's pretty good, isn't it? I mean, on the other hand, Goldman, I think, is fair to say, put out a report 3 or 4 weeks ago in which they said that the PE ratio on the S&P 500 is high. So as opposed to 10% average return over the last century, they're projecting 3% for the next decade. So that's rather cautionary. It's not get out, it's not sell, but it's, moderate your expectations. On the other hand, a 10% gain between now and the end of 25 would be good business. So I think what this shows, Haslinda, is that investing in the short run is very uncertain. And nobody should think they really know what's coming. And most people should take an almost passive approach. The idea is it's good to invest. It's good to invest in the United States. It's good to invest over time. And it's bad to try to mastermind it in the short run with get in, get out. Now, if everybody gives up and getting in and getting out, you may lose a few viewers. The point is, investing is a good thing. Do it early. Do it a lot so that you can build the nest egg. Don't screw it up.
You talk about how it's hard to do it on a short-term basis. Okay, let's take a longer-term basis. 4 years, Trump administration, looking at who he has suggested in terms of his cabinet picks, Lutnick, for instance, for commerce, and probably Wolf for Treasury. How are you looking at that? How might that impact market sentiment and how this plays out?
Again, these things are very hard. Number one, what's going to happen? Nobody knows. His appointments are not, they have yet to be confirmed. His policies are not known. What is he going to do? Nobody really knows what he's going to do. Two, what else will be going on in the world? He's not the only show. It's complicated. Number three, how will the market react to all these things? Number four, the president's influence on most things is usually quite limited. Number five, as I said before, our investment economy is in good shape. So, in general, things are going well in the United States and or better than most other places. And that's why things are high in the United States. So the situation is generally good, but you're paying a lot for it. We'd like to get a good situation at a bargain price. It's rarely the case. I don't think things are crazy high now, and I don't think it's time to get out.
Reading into the president's relationship with Elon Musk, for instance, has been put in charge of the Department of Efficiency. We saw Trump at Musk's event, SpaceX, just today. Do you read into the potential of perhaps how Tesla might play, might gain from that? Do you see the potential of EVs gaining from that? How do you read into that?
Well, I'm not smart enough to know the answer to that question. I think that this is a very unusual situation, one we've rarely, if ever, seen before. Romance, if you will, between a president and a founder of a company. There's no doubt about the fact that Musk is brilliant, idiosyncratic. People have been talking about increasing efficiency in government and eliminating fraud and waste for decades. I don't think anything's ever been done about it. And the question is, I assume that what's going on means that Musk will do more about it than has been done in the past, and then we'll get to see whether it works. But, relationship with Musk and Musk's role in government produces an improved outlook for Tesla is very attenuated. I wouldn't go there.
Elsewhere in the world, China has been front and center. We're seeing stimulus in an attempt for China to revive the economy. Do you think China's doing enough? I mean, I know you see value in some Chinese stocks.
China is attempting something very difficult. They had what I call the Chinese miracle. They had 10% GDP growth a year for a few decades when they were coming into the modern era. A lot of that, or some of it, was built on stimulus. You can't stimulate your way to growth forever. They've tried to back off on the stimulus. That has caused a growth slowdown. That they don't want to have the full brunt of that slowdown. So they're trying to kind of calibrate. That's the word I use in many cases. They're trying to calibrate the right amount of stimulus to produce good growth, not an excessive reliance on stimulus. And stimulus sometimes leads to unwise behavior. It's not hard to get. It's not easy to get it right. I'm hoping they will. I know they're dedicated to the task. They understand the importance of 5% GDP growth. And let me just say, 10% sounds like a slowdown versus 10, but it's a well above average growth rate compared to the rest of the world.
You don't know how it's challenging for China.
Yes.
Is that been something that's so difficult? Why isn't China a value trap? Why is it still, full of value?
Well, I think because first of all, it has great potential to come into its own. I mentioned before that the U.S. situation is doing well, high-priced. The Chinese situation has fundamental questions, but it's bargain-priced, which is better. You can't. It's all investing. It's a matter of relative choices.
And risk that its nascent recovery might be jeopardized by Trump's policies and further tariffs on the economy.
Well, if you could tell me what Trump's really going to do as opposed to his rhetoric, and if you could tell me whether Trump's rhetoric is going to induce behavior on China's part that makes Trump back off from his rhetoric, then I may know the answer. Nobody can do that.
Where do you see value in China?
Well, I'm not close enough to the operating level to be able to talk about.
Have we seen the end of the crisis in the property sector, for instance? Is there a sense that, because it takes a recovery in the property sector to actually revive investor sentiment and confidence?
Well, any time you have an amount of building which is highly stimulated by the availability of capital, then you have to go through a period of adjustment in which the buildings that have been built are absorbed, and some have to be repurposed. Some growth, you have to grow into that space, and that doesn't happen overnight, and it doesn't happen because the government turns a policy lever. It's going to take some time. The question is not whether they have to do it. The question is, will it amount? Will they stop adding excessively to the property, and will they put in place policies designed to create the absorption? My bias is that they will, and many people in the investment community describe China as uninvestable. To me, that word is music to my ears. I've made my whole career buying assets that other people consider uninvestable. And when you do that, you have a chance of getting a bargain. So I think that clearly China is on the pile of things that people feel ill about, and it's on that pile that you find the bargains. That doesn't mean that you should buy everything on the pile, but that's where you look for the cast-offs and the bargains.
So you've been adding to your positions in China?
Well, we have a good position in China, and have had it for a long time.
Can you share some of the position in any way?
No, I don't go into names. But, we're continuing